In the complex world of investing, it's crucial to avoid big mistakes if you want to succeed financially over a long time. It doesn't matter if you're new to investing or have done it before. Avoiding common problems can really help your money grow. In today's video, we are going to talk about 5 common investing mistakes and find out how to avoid them. This will help you make smarter and more careful choices when you're building your investment portfolio. Number 1. Not having a plan. Not having a plan is a major investing blunder that both beginners and experienced investors should make sure to avoid. In the intricate world of finance, a clear investment plan acts like a guide, helping with decisions and reducing the chances of making quick choices based on market changes or emotions. If you don't create a plan, you might end up with a disorganized approach that leaves your investments vulnerable to market ups and downs and unexpected situations. Without specific goals, an evaluation of how much risk you're comfortable with, and a timeline for achieving your financial objectives, you could make misguided decisions that hurt your ability to build wealth. Investment plans offer a structured outline for how to distribute your assets, diversify your investments, and manage risks. Without this solid foundation, you're at the mercy of the market's unpredictable nature, making it hard to withstand market downturns or take advantage of opportunities. Investors who skip making a plan often catch themselves following trends, giving in to the fear of missing out, and making choices driven by short-term market shifts. This can result in unnecessary trading expenses, unstable portfolio performance, and not getting the most out of your investments in the long run. Not having a well-thought-out investment plan is a crucial error that can hurt your financial success. People looking to invest are advised to carefully put together a thorough plan that matches their goals, how much risk they can handle, and how much time they have. Such a plan acts as a defense against hasty actions, making sure you approach investing in a more reasonable and disciplined way. Number 2. Not doing your research. Not doing proper research is one of the key mistakes investors must absolutely avoid. In the finance world, knowledge is truly power, and neglecting to thoroughly research before making investment decisions can lead to significant financial problems. The consequences of skipping proper research can be serious. It means making choices based on incomplete or incorrect information, increasing the chances of making bad investment decisions. Without a full understanding of a company's financial health, competitive landscape, growth potential, and potential risks, investors put themselves in unnecessary danger. Ignoring research not only makes it hard to find promising investment opportunities, but also hinders the creation of an informed strategy. It prevents investors from having the tools to assess market trends, make smart decisions, and adjust their portfolios in response to changing situations. Even though the digital age has made information more accessible than ever, the temptation to take shortcuts can lead investors astray. Research requires a commitment to delve into financial reports, industry trends, management teams, and broader economic indicators. It demands careful work and a discerning eye to separate valuable insights from the noise. To avoid the serious mistake of neglecting proper research, investors should take a disciplined approach. This involves setting aside time to gather, analyze, and understand relevant data, seeking guidance from reliable sources, and developing an understanding of the details of their investment options. By doing this, investors can arm themselves with the knowledge needed to make informed decisions, reduce risks, and navigate the ever-changing world of investing with more confidence. Number 3. Investing too much money. Putting too much money into investments is one of the critical mistakes in investing that needs careful attention. While the promise of high returns can be tempting, investing a disproportionately large part of your money in a single investment can leave you financially exposed. The outcomes of committing an excessive amount of money to one investment can be serious. It increases the risk of losses, putting a significant portion of your wealth at stake if the investment doesn't perform well or if the market unexpectedly changes. Diversification, which is a key principle of smart investing, aims to reduce this risk by spreading your investments across different assets to minimize the impact of a single setback. Investing too heavily in one venture also means missing out on other potentially lucrative opportunities that might come up. It limits your ability to adapt to changing market conditions, technological advancements, or shifts in consumer behavior. On the flip side, A well-diversified portfolio positions you to benefit from different sectors' gains while reducing your exposure to the struggles of any one company or industry. To avoid the danger of investing too much, finding a balanced approach is crucial. Investors should carefully evaluate how much risk they can handle, their financial objectives, and their overall portfolio strategy. Diversifying across different types of assets, industries, and geographic regions helps manage risk while still allowing for growth potential. Being prudent about how you allocate your assets ensures that no single investment has too much control over your financial security. In the realm of investing, moderation is a valuable quality. Striking the right balance between how much you invest in diversification lets you enjoy potential gains while also protecting yourself from the significant losses that can arise when you put all your eggs in one basket. Number 4, not diversifying your portfolio. Failing to diversify your investment portfolio is a significant mistake you should definitely avoid. Diversification serves as a financial safety measure, but ignoring its importance can expose investors to unnecessary risks. When your investment portfolio lacks diversification, it becomes overly dependent on the performance of a single asset or a narrow group of assets. This concentration increases your exposure to market volatility, potentially resulting in notable losses if a particular sector or asset class doesn't perform well. The repercussions of not diversifying can be substantial. Economic downturns, setbacks in specific industries, or unforeseen events can disproportionately impact an undiversified portfolio. The lack of balance puts investors at risk of significant drops in net worth, which could jeopardize their long-term financial objectives. In contrast, a diversified portfolio spreads risk across different asset classes, industries, and geographic regions. This approach aims to counterbalance losses in one area with gains in others, stabilizing overall returns and providing a buffer against market fluctuations. To avoid the trap of inadequate diversification, investors should strive for a balanced allocation across various types of investments, including stocks, bonds, real estate, and cash equivalents. This strategy can help navigate the unpredictable nature of financial markets and mitigate the effects of unexpected events. Ultimately, diversification is a vital tool for achieving financial stability and long-term success. By embracing a diversified approach, investors can enhance their potential for consistent, long-term growth while minimizing the negative impact of concentrated risks in their portfolios. Number 5, trying to time the market. Trying to time the market is a dangerous investing mistake that both newcomers and experienced investors should definitely avoid. This blunder involves trying to predict the exact moments to buy or sell investments based on short-term changes in the market. However, the truth is that consistently succeeding at timing the market is a difficult task with significant risks. The outcomes of trying to time the market can be harmful to your finances. The unpredictable nature of markets makes accurate predictions nearly impossible, leading to potential losses. This approach often comes from emotions and speculation, rather than solid financial analysis, resulting in decisions driven by fear or greed instead of logic. Timing the market also goes against the principles of long-term investing. This practice undermines the benefits of compounding, which relies on the gradual accumulation of returns over time. Investors who try to time the market might miss out on significant gains during periods of growth while risking losses when the market goes down. To avoid falling into the trap of market timing, investors should adopt a more cautious approach. The focus should shift away from trying to predict short-term market movements and instead concentrate on fundamental analysis, diversification, and a long-term perspective. Spending time understanding the intrinsic value of investments and their potential for growth can protect investors from the dangers of making impulsive decisions based on market changes. If you avoid these usual mistakes, you can improve how likely you are to succeed in the investing world. Keep in mind, investing takes a while, so don't let yourself feel down because the market goes up and down quickly. Stay concentrated on what you want to achieve and stick to your plan. If you do this, you'll be on a good path to doing well financially. Thanks for watching. I hope you found this video helpful. If you have any questions, please leave a comment below.